Good evening, and thank you for joining us to this sort of a special educational event. I want to welcome all of our Fidelis limited partners, prospective investors, and guests. Thank you for coming. Our partnership has recently grown beyond 250 limited partners, which is sort of remarkable considering we started with fewer than 5 in 2019. In November, we celebrated surpassing 100 million. Recently, as of now, we're at 121 million. So I think this partnership the growth of this partnership just represents the strength of this partnership and all of our investors that most of you of all here make this partnership strong. Tonight's program has sort of been on my mind a while because I always run into people that they just, for some reason, don't realize there's other ways to invest your funds than in the stock market, from retirement funds like their 401k and their IRA funds. So before I introduce our guest speakers, I want to ask you a question, and I want you to be honest with yourself. Are you sleeping well with your investments in the stock market? Because a lot of the people I know aren't. And I think given the volatility of the market, it seems like these markets, they're swinging with every change in the headlines. And I hope our limited partners are sleeping well, because every quarter, without exception, they get their distribution, they see their investment compound, and there's no surprises, there's no drama. It's just consistent, above average returns, and that's what we do. Since we started in 2019, through COVID, through the interest rate shock of 2022, everything the market has thrown at us, we've generated over an 8% annualized return. As of this last quarter, no exception, we're at 9.31%. Here's what makes tonight sort of timely, is that all of us, or at least most of us, have capital invested in traditional IRAs tied to the market volatility that I've been talking about tonight. The self-directed IRA is sort of the chance to change that. And with Fidelis, it's pretty simple. You open an account, direct the custodian to send the funds to Fidelis, and watch your investment just compound, tax-deferred, secured by San Diego real estate. Tonight, Paul Hynes and Mark Petrie of Aspiriant Wealth Management, they're going to share with us, how to use your 401k for investments in alternative investments like Fidelis.
Thank you, John, for inviting us. I met John for the first time as we planned this. I knew Chad Rule from many, many years ago. So Chad, thanks for the opportunity. So a little bit about Aspiriant, as you can see on the screen, just a few numbers. We have offices across the country. We have one in New York. It's actually in the Empire State Building. Pretty cool. About 17 billion of assets under management, 230 plus employees, of which about a third of those employees are owner partners. Mark, Petrie, and I are owner partners. And as John mentioned, we don't have any outside investors, no third-party investors, no outside money, no private equity. So we can stay in alignment with our clients, which we feel is really important. Mark, I'll invite you to come up and talk about not just the how, but the why you want to consider using alternative investments.
Thanks, Paul, and thank you for having us today. When we construct portfolios for clients, we recognize that there's times in the investment cycle where stocks are really, really attractive, right? You come out of a recession, you come out of a financial crisis, you come out of a real estate downturn. Usually stocks are down at the same time. When stocks are cheap, when companies are under earning, you can look forward and you can look at very attractive returns for stocks. There's other times in the cycle where stocks aren't cheap, they're expensive. Company profit margins are at all-time highs. High-yield bond spreads over safer treasuries are at all-time narrow levels. Cap rates on real estate might be low at the same time. At these times, you look forward and you do the math and you say, under normal circumstances, future returns for stocks aren't as attractive. And this can spread. So when stocks are really attractive, you can expect 15 to 20% returns from stocks over a 7 to 10 year period. In fact, that's what we've experienced over the last 15 years or so in the US. When stocks aren't attractive, you can look at math and say, maybe stocks are going to give me a 0 or 5% return potentially over the next 7 to 10 years. This is how we think about the market cycle. We have a process, it's called capital markets expectations, and we do this math on every single asset class across the world, including real estate. And we risk manage portfolios across a market cycle, meaning when we're being compensated for the risk of stocks, because they're always risky, we're willing to move heavily into stocks and out of safer assets. When we're not being compensated for taking the risk of stocks, like maybe starting today, and I'll show you some numbers about that, then we take a more diversified approach. And this is what we do with our risk managed portfolios. We never want to market time. We don't want to go to cash, wait for years potentially, lose to inflation. But we do want to risk manage our clients' portfolios. And to do so, we use a couple of tools. And that's where what Fidelis does fits in. Diversifiers are non-correlated investment strategies. They're not stocks. They're not as volatile as stocks. They don't move on the same news and the same economic circumstances as stocks or geopolitical issues as stocks. And they're not bonds. They're not sensitive to interest rate movements or inflation. They're their own source of return. When you think about diversifiers, you can think about things like this. Think of these as hedge strategies. You hedge away the volatility of markets. You know there's a historic pattern of two things moving together in a normal way. They deviate. You hedge away the market risk, and you make a bet that those two things are going to come back together. That's what a lot of hedge funds do. So this is what we do. This is how we manage risk. We try to maintain the same return for our clients that they need to meet their goals, but we try to dial back the risk lever in doing so. So this is why we risk manage portfolios. This is why we tilt things towards diversifiers, towards defensive equities. And this is why we don't solely rely on bonds to manage risk. So when we think about Fidelis and the market that they participate in, and we think about the tools that we use to manage risk, what Fidelis does certainly fits in the toolbox of the things that we look for to generate a return that's competitive with other things out there, with a differentiated source of return, a repetitive source of return, a secure source of return, without all the volatility that comes with stocks or your traditional 60-40 portfolio.
So that's a real great overview of why we consider using these types of non-correlated alternative investments. I'm going to get a little bit into the practical side now. In fact, there's tens of trillions of dollars in IRAs, and many people have $1 million plus in their IRA. So it is a very relatively new thing to have that much money in IRAs, but now it's considered a source of capital to invest. And when you invest in something that's not a traditional stock, bond, or mutual fund, you need to use a different type of IRA custodian than the normal IRA custodian. So if you want to invest in something like a Fidelis fund, you need to go to another type of custodian. And if it is your IRA, you need to find an IRA custodian. And John and his team have a list of suggestions. So I took that list and I started doing some due diligence on that. And you'd want to do your own due diligence on that. Once you select the custodian, you need to open the account, fund the account. That means put the money in it. You can do an IRA to IRA transfer. So you can move it from your existing IRA to this new custodian. So it's a tax-free transfer. Then once the money's there, you instruct the custodian to send the money to Fidelis. You want to make sure you do it in that order. So if you want your IRA to own an investment such as this, don't make the investment first and then decide you want to have it in your IRA. Go through these steps, get the account open, fund the account, have the custodian direct the money to the investment you want to make. The question was, what's the main benefit of having an investment such as the Fidelis fund in your IRA? The main benefit is the tax deferral. Another benefit could be, let's say you have a Roth IRA. Roth IRA, I'm guessing most of you know what a Roth IRA is, but I'll just briefly explain it. The Roth IRA, you put the money in after you pay taxes on it. When you take it out, you never pay taxes again. Just the reverse of the traditional IRA where you put the money in before taxes. When you take it out, you get taxed. You don't pay taxes on the gain, ever. You might have heard some stories where some private stock investors have billion-dollar IRAs because they bought companies when they're really low priced and sold them when they're really high priced.
All right, I just want to thank Paul and Mark for coming tonight. You know, I appreciate the insight they provided in our conversation, so thank you. Okay, I'd like to close with one more perspective. You know, when in the stock market, exciting is seeing your portfolio rise 20%, drop 20%, rise 30%. At Fidelis, we don't do that. We do steady, we do consistent, we do protected. We do it quarter after quarter, and we've been doing it since we started. It's just the consistency. Consistency isn't exciting, and we think consistency is better than exciting. And that's sort of what we do. We're not hitting home runs, we're hitting singles every day. And so that's our philosophy.